from week over week, or $27.50 per contract, so about 27 cents a share. Now, if we are correct, and this does travel lower, below 41, we can make a minimum of $72.50 a share, or 72 cents. So this is what we call an inverted option collar. What's really unique about this trade setup is it gives us a risk-free, or a relatively risk-free way to bet down on an asset. Now, I could have turned around and just spent 27 cents on a put option, but if I was incorrect, I would lose 100% of that 27 cents and have much less capital at work to generate a profit from. So instead, what we're doing is we're buying 100 shares of the underlying asset, in this case, emerging markets. We're using that to leverage the call option market. So we're selling an in-the-money call for $2.04. So if we do look at the math on this, we're currently trading at 43, and we're agreeing to sell it for 41. So if we're assigned, we're essentially going to break even on that, because we're going to lose $2 on the underlying asset, but we're going to pick up $2 from the option premium. So on the long side of the trade, we really have nothing to win. And in fact, all of the losses we would generate would be from that 29 cents we invested in the put. But what might happen if the value of the EEM ETF goes down? Well, we're going to be generating a profit on the short call, and we're also going to be generating a profit on the put option. So it's a setup that allows us to generate a greater return on the options than we're losing on the underlying asset. So it's a super safe trade, very little to risk if emerging markets travels higher, but if it does travel below 41, we can realize a nice profit. And also, this doesn't have the ability to track the implied volatility with our time premium. So come next Tuesday, we're still going to have, let's see, 1, 2, 3, 4 trading days of time premium left. So if the VIX is going up, that means the value of put options will be increasing rapidly. So I would suspect that we can make more like $1 a share if this emerging markets goes below 41 come next Tuesday. So this was our same trade we did last week. Now remember, Tuesday of last week was when we woke up to the news from London that Trump said we may have to do a trade deal after the election. Stocks were tanking, the VIX spiked, and that was the best information we had in terms of the health of the trade deal at that time. So we did the exact same trade, but starting at 42.13. So now we're a little bit higher. We're about $1 higher. We're putting on the exact same trade. I want to protect our portfolio through Sunday. So Sunday is when these tariffs are supposed to go up. We're getting mixed news as always that maybe they'll extend the tariff deadline. Maybe they won't. Maybe it'll go up. So it's really up in the air. Meanwhile, the big picture for China is their growth is slowing. Their imports and exports are slowing, and they're not expanding their money supply or their credit supply like they have in the past. So it looks like they're actually trying to allow their economy to slow down to potentially put pressure on global markets and eventually on the United States, as I think they really don't want Trump to be elected and continue this foreign policy. Okay, so that's the current trade. Here's our open positions. We're long on the SPY with a tight option collar. So we sold the 316 call and we bought the 314 put. This means we give up profits on the SPY if it travels above 316 between now and tomorrow. But on the other hand, if the trade deal were to break down and SPY were to tank, we still get 314 a share no matter what. And that's because we purchased that 314 put. And I did notice we got a new fellow joining in, Arturo Ruiz. Welcome. If you have a microphone, we'd love to hear from you. And right now we're reviewing our open positions. Okay, TLT is down about 30 cents. Now, there's a lot of risk on owning the TLT if a trade deal is striked. And so we've already seen what the long end of the Treasury's done over the last few months. It's gone up while the short end has tanked to very low rates. So this means the long end has a huge move in terms of yields going down. Let me just pull up that chart so this makes more sense to everybody. So we can see ever since the repo madness came in, we went from the short end of the Treasury yield curve being way up here around 2% to dropping all the way down to 1.5%. And at the same end, the bonds, the 20-year and 30-year, went up in yield. So my expectation is if the trade deal does break down, that these long end of the Treasury, the bonds, will come down in yield to get closer to where we're at in the T-bills and the notes. So we have the T-bills here in the front, we have the notes right here in the middle, and then the long end, we have our bonds. And so the big bet on the TLT is that this could come down potentially back down to where it was at 2%. So that would potentially push the TLT. Let me pull up a chart for you guys. So just to get back to where we were in August, which you can see this huge move. This is what happened to the TLT the last time the trade deal broke down, as we had a run from 131 to 148. Huge move to the upside. Now, it did pull back considerably with the whole repo madness, but the Fed currently is just buying the front end of the Treasury. So this has allowed the long end to climb up in terms of yield. And my expectation is to quickly jump right back to that 148 level as we see that there's just not going to be a phase one trade deal. Now, on the other hand, if we do get positive news like we did in July, perhaps we could travel as low as 132. So as far as the risk to reward on this trade, I think the bare bones minimum that we could see from the phase one trade deal breaking down is to go right back to that 148 level. But on the other hand, if the trade deal does come out with tariffs being removed and China is going to buy $40 to $50 billion of agricultural products, then I'd say the worst case is for the TLT to potentially go down to 133, perhaps like we were in June or July. And so if we look at our current trade, you can see we're long the 138 put. So this was an expensive week to buy downside protection because we know there's a catalyst right in front of us that could cause the market to go one direction or the other. So if we get a deal, most likely bonds and gold travel lower and stocks sling much higher. If we don't get a deal, then the exact opposite can happen. And so the worst case for us, if a trade deal is striked, is that the TLT crashes, but we get 138 a share. So that's only 81 cents from here. And we would lose some of our option collar that we purchased for that downside protection. On the other hand, we can benefit from the TLT traveling as high as 143 before we miss out on profits. So we're set up to get a huge win on the TLT currently, and most likely we'll have a very similar trade to this on Thursday. Now, once we do have outcome from the trade talks, we can spend a lot less money on the downside protection and be able to follow our trading plan. And just to review our trading plan, if the trade war is up in the air, we essentially just want to be long all of these assets with a loose option collar and then a tight option collar on GDX. So we'll still be betting up on all four assets. But the problem right now with this slide, even though the trade war is certainly up in the air, is that we have a catalyst coming on Sunday that without it being delayed, should cause either this setup, an escalation in the trade war, or a de-escalation in the trade war. And so if the trade war escalates again, we've seen time and time again, the market reacts the exact same way. Stocks tank and bonds and gold go up. So knowing that this is right around the corner, we've essentially done this setup right here, but with very, very tight option collars. Now, also in general, if we do look at the history of the SPY against the TLT, the SPY will generally just slowly but surely work its way higher and higher until it has volatility shocks and spikes down. The TLT works exactly the opposite. It will tend to trade flat or slightly down and then spike higher when the stock market has a big sell-off. And that relationship between the SPY and the TLT is what makes this strategy so safe and so popular. And so that's what Ray Dalio is doing with his most big hedge funds do just about exactly what we're teaching, except they can't take advantage of the option market like we can because they're managing $100 billion. So with our portfolio, we can easily buy and sell these options and have extremely low risk and no problem getting in and out of our positions. So it does give us a big advantage compared to the big boys. Now, GDX is kind of like the bond market on steroids. It behaves very similar to the TLT, except it does better with a lot more fear. So we've had interest rates going lower. We've had the Federal Reserve buying the short end, the T-bills. So those are all your treasuries that expire in less than a year. And the last ingredient for GDX to go up besides those two is for some fear in the market. And so gold market's done well for us, but again, it's a slow bleed and then it pops. And my expectation is that we will have some volatility to close out the year because the trade deal is not going to be closed. Here's a look at our returns to date. Our total return in 12 months is 14.5%. But what's important about our strategy is your maximum drawdown against your return over the course of a year. So our risk is 1% to deliver 14.5% return. So that's like risking $1 to make 14. If we go look at the SPY, you're risking something like $18 just in last December's crash to make $24. So the ratio of risk to reward in our strategy is far greater than just buying and holding stocks. And I do think we have already hit the high of the year for the S&P 500, as I think there will be no trade deal to give us a catalyst to go much further. And when we do look at some of the topical news, we'll look at some interesting predictions from some experts on the repo market and the treasury market coming up in a minute. Now in the trade alert, I do break down the returns per asset class so you can see which months have made money and lost money broken down per asset. But again, it is the best results will be achieved by following the full trading plan, not by just trying to pick one or the other. Now I have a lot of clients who just love to trade the SPY, and so they've done fine. In this portfolio, we're up 12% over the course of a year. So we've averaged that 1% return. But you can see we've had 3 months where we lost money. Now we had some good returns in January and February. But again, because we're using option callers, those act typically as a drag if you're predicting an up move. Now, most investors are not set up to do well if stocks don't go up. And in fact, they have very little recourse for how to generate a profit. Our portfolio, even if you're just trading the SPY, can actually make a profit from the SPY traveling lower by owning the asset. And again, the key to doing that is by understanding how to place this simple trade right here, which is the same trade we just put on today on emerging markets. And the basic idea is to sell an in-the-money call option and buy an in-the-money put. And this allows us to actually own the asset and generate a nice, safe return betting down on that asset class. So until we get some certainty in the trade talks, we'll most likely continue to be bullish on our SPY. Okay, moving down, here's the Tuesday trade, which is trading emerging markets. This has had a total return of 12.7% because it did give up a little bit in December, a lot, 4.3%. This is only 10% of our total portfolio. So I'm willing to take bigger risks to achieve bigger returns with less of my capital. So while we have 40% trading the SPY, we only have 10% trading emerging markets. So this current setup is a low risk trade because we have this catalyst coming Sunday and we have totally mixed news coming in at us. So we're just playing it safe in today's trade. If the talks break down, we're going to do very, very well. But if the tariffs are delayed, which seems to be what may happen, we're not going to get burnt, and emerging markets could still sell off. It's been having a lot of trouble. We've seen the SPY and emerging markets begin to diverge since November. And quite often, the smaller market will lead a downfall in the larger markets. Our bond portfolio, again, has had 4 losing months so far out of 12. And it's really when you overlap all of these that you can get such a smooth return. So we've only had 1 losing month if you follow the full trading plan. If you're trying to cherry pick which portfolio you like better, you've still got about the same 12% return no matter which portfolio you pick. As you can see, this portfolio is at a 13% return. But the catch is you've had bigger periods of drawdown. So it's when you overlap all the trading plans together that we can have a very safe strategy with very little risk of losing capital. And finally, our last portfolio, which has taken on the most risk by far, is our precious metals portfolio. Now, we have increased the position size of this over the past 12 months. So the sum of the monthly returns is far greater than the total return. So I just want to make sure people understand that. As we've grown the portfolio size from 2.5% to 5% to 10%, that's because the central bank went from being very hawkish in December, saying that we have rate cuts all year, or rather rate hikes and quantitative tightening. And market hated that in December. We sold off 18%. And then he did the Powell pivot, where he said there's no more rate cuts, or rather rate hikes in February. And then by the rest of the year, we've seen 3 25 basis point cuts. And now we've seen massive quantitative easing, more quantitative easing since September than ever before in history. And we'll take a close look at that soon. Now, this is a visual at our returns, where you can see in December when stocks sold off, 18%, we generated a 1% return. When the market does go up, we're not trying to lose money, obviously, and we've still done well in those environments. But the big selling point to following our program is the ability to protect your assets in downturns and generate profits during volatility. And so you can see in May, stocks sold off 8%. We picked up 2.2% return. In August, right after, literally a month after he told us we have a farm deal with China, surprise, we don't. And he threw out the threat of tariffs in October, which have been delayed so far, and a huge tariff in December. And so we'll see if he holds to his word or not. But in August is when he surprised the world, and we got that sharp sell-off of 7%. Now, in October is when we got this supposed phase 1 trade deal where Trump went on TV and bragged about getting China to buy $50 billion of agricultural products. And it looks quite likely that China will not purchase anything to anywhere near that amount of agricultural products. And to get any deal at all, they're actually wanting all tariffs removed. So that would make Trump look very weak. Now, in the next part of the trailer, we do show you visually how to get in and out of the trade. So this is how you close out the previous trade. If you didn't take the previous trade, you'd skip step 1 and you can head over to step 2. Current trade per 100 shares of emerging markets is to sell to open the December 20th 41 call and to buy to open the December 20th 42 put. And below that, we give you a risk graph so you can see what your risk reward looks like. In this case, maximum risk is 27 cents a share, and maximum return, at least at the expiration date, would be 72 cents. Now, when we're betting down, like we are in this trade setup, and we have a lot of time premium left on our put, which we will on Tuesday when we roll this position, we can actually make a lot more than the graph would indicate. So I'd suspect if the emerging markets is below 41 come next Tuesday, we could be making more like about $100 a contract instead of 72. So that's actually a 4-to-1 risk to reward ratio potential coming into Tuesday. Okay, so that's an overview of today's trade alert. Let's take a look at the top news. So it's official. The Democrats have unveiled 2 articles of impeachment. We got a little tweet from Trump to impeach a president who has proven through results, including producing perhaps the strongest economy in our country's history, to have one of the most successful presidencies ever, and the most importantly, who has done nothing wrong, is sheer political madness. So most likely the House will vote on this before Christmas, and they hold the House. So I suspect that that will be passed, and we'll go into the Senate in January, where there's very little chance of 2/3 of the Senate voting to impeach Trump. So is this just a big show? Markets are not reacting very much to this news. In fact, CNBC will only cover it for a few minutes at a time, but they are, again, the cheerleader of the stock market. The next thing we're looking at, the flow of our live stream content is first we look at the big picture with China, as that's really the main piece of the puzzle that's going to make the market either go up or down. So we're paying close attention to our relationship with China. China's facing massive inflation, which in general should cause them to stop creating debt and to hike interest rates. And so we've seen pork inflation. There's a piece out from Apple, deeply concerned that Chinese-born staff have stolen trade secrets and are trying to flee to China. Wall Street Journal, tariff delay to take place as US-China continue to haggle over how to get Beijing to commit to massive purchases of US farm products. President Trump is insisting for a near-term deal. Lighthizer is traveling currently. I think he's out in Mexico wrapping up the USMCA deal. I don't think he's going to be too happy about this decision if it is delayed, and it's not official yet. So we've had Mulvaney come out and say it depends on talks this week. We've heard Wilbur Ross come on Fox Business this morning, also uncertain as to whether we'll push tariffs or not. And you can see China is slowing down its debt growth. Its shadow credit has been on the decline for 2 years. Their social credit has slowed down dramatically. Their imports and exports have flatlined. China is expected to import 87 million tons of soybeans in 2019, said a monthly forecast by Chinese Agricultural Ministry. The number is slightly up from an estimate in November, as imports from the US are expected to rise after China issued a new tariff waiver on US shipment. So this has been China's little trick. They'll go buy a small amount of soybeans and pork and then tell us that we want to do a trade deal. And then once it comes to actually creating a deal, they won't sign anything or agree to anything. So they've been doing this on and off for 2 years. A message to US ahead of the planned tariffs, and this is from Global Times Business. China's foreign ministry blasted calls in US for decoupling and other rhetoric promoting confrontation, stressed potential for cooperation, and urged US to drop Cold War mentality to work with China for a stable relationship. Opinion: China doesn't need to rely on the US to ensure domestic pork supply. Brazil is likely to become the biggest beneficiary of China's expansion to pork imports. Chinese banks extended 1.3 trillion yuan new loans in November, and they grew their money supply by 8.4%. That's slightly faster than they did last year, which was about 7.2%. They've printed 211, I guess now we're up to 212.3 trillion yuan. They value those yuan at approximately 30 trillion US dollars, and they have lost $1 trillion of their foreign reserves. So they're claiming their money's worth $30 trillion. However, to back that up with the actual exchange, they only had $4 trillion, and that's now down to $3 trillion. So they're quickly running out of dollars, as is most emerging markets. Here's just a picture of all the pollution in China that you can see from afar. Some timing from the White House: 12:15 to send the deal, text to Hill, 12:17 impeachment vote, and then 12:18 the USMCA vote. China is now trying to supposedly end their concentration camps, as this has been brought to full light recently in the media. Their inflation is rocketing higher. This is very bad for China. And again, if they have to hike interest rates and slow down debt growth, this could certainly cause a major panic in emerging markets. Their car sales have been slowing in growth for the past 18 months, often looked at as a leading indicator for stocks. My understanding is that the Xinjiang vocational education and training centers have made decisive progress both on de-radicalization work and on raising human rights standards. China hopes that it can reach a trade deal with the US that satisfies both sides as soon as possible, China's Assistant Commerce Minister said at a press briefing on Monday. Trade's down 11%. Okay, now we're looking at some information on the repo madness. And there's a prediction that with taxes due at the end of the year, that we are going to have another run on the repo rates. And so there's been tons of noise about this for the past 3 months. But the effect has been that the central bank has increased their balance sheet by about $320 billion, the fastest growth of their balance sheet in all of history. And the last time this happened was right before the 2008 crisis. Now, this is from Credit Suisse, and essentially they're expecting that there's going to be a shortage of dollars in the banking system coming into the year end that could cause the Fed to have to go into official QE4 by the year end, and that this may cause Treasury yields to spike. And that the Treasury will have to switch from buying Treasury bills, the front end of the market, towards the long end, which is where we're positioned with our TLT. So that could be very beneficial to the TLT. And once again, I'll look at that yield curve again in a minute. So we have Lighthizer out in Mexico. While there's rumors of the tariffs being delayed, I'm sure he's not going to like that. Lighthizer's the biggest hawk on the trade talks. For the non-repo market plumbing experts in my thread, you may be hearing noise today about this guy with a really cool name, Zoltan Posar. He works for Credit Suisse, formerly worked for the Federal Reserve and US Treasury, has a tremendous knowledge and unique style of extremely detailed analysis. And he's expecting that essentially JP Morgan, Citi, Bank of America, Wells Fargo are going to stop lending out money overnight to force the hand of the Federal Reserve to basically go into massive QE. And we've watched what has JP Morgan done with their portfolio over the last 12 months. They've increased their bond position by 50%. So they're by far the most connected bank in the world to the government and to the central bank. So my expectation is they're planning to flip these bonds to the Treasury or to the Federal Reserve for a huge profit. And to do that, they're going to need a nice crisis to give cover for why they're going into QE4 while stocks are at all-time highs, unemployment's all-time lows, and supposedly everything's great according to Powell. So Zoltan's essentially predicting that this will happen before year's end. So tomorrow is the next Fed meeting. My expectation is no rate cuts. So we'll see what exactly comes out tomorrow and how they explain why the repo market continues to grow in size when this was supposed to be fixed as a technical issue within a few weeks. Will the Fed announce another year-end term repo after the 3 originally scheduled ones were oversubscribed? And New York's 28-day repo oversubscribed $43 billion of bids, and they're only accepting $25 billion. So that's top news. Now let's take a look at this. Oh, here we go. Okay, so here's when the whole repo madness began in September. And so you can see we had an inverted treasury curve, which has signaled a recession almost every single time we've had a recession. Now, what this means is the short end of the bond market is paying a higher interest rate than longer duration bonds. And that's just not the way it's supposed to work. The bank is supposed to be able to borrow for less and then lend for more for longer duration and generate a profit. And when this inverts, it creates a lot of problems for banks. And so what did the Treasury come in and do? Well, they came in with repo. And so these first 3, as you can see, are what we call the T-bills. So it's any bond with an expiration that's less than a year. And so they came in and said, this is not QE because we're buying short-term debt. So they came in and have purchased $60 billion a month of these short-end bonds or T-bills. Now, what happened was it drove the yield significantly lower, and we saw the long end, which is what we own in the TLT, go up. So if the yields go up, that means TLT goes down. So the big expectation now is that the Fed's going to start purchasing longer duration bonds because there's going to be more and more problems in the repo market, the overnight lending market. And so we can see if these 2 dots do catch down with where they've pushed the front end, there's a tremendous profit to be generated in the TLT. So just to get back to where we were in September, you can see it's only this move right here. But I'm expecting this could go below 2%. So a lot of potential profit on the TLT if the Treasury were to start buying the actual bonds. Now, maybe they'll buy the notes first, but regardless, the further they go out, the more this will compress these yields lower and lower. So I do think we have a huge profit to achieve in the TLT in upcoming weeks. Now, if the repo madness had been getting lesser and lesser, if we saw that they're being undersubscribed and that the balance sheet growth was slowing down, that would be one thing. And I'd be much more bullish on stocks at this point in time. But it's just not what's happening. We're having the repo problem get worse and worse. And so most likely there's something very wrong in the financial system that they're trying to cover up. And so the last time repo rates were spiking again was right before the 2008 crisis. Okay, so now I want to look at the dollar index. Let's look at some currencies. So what I'm pulling up now are the most important currency pairs that we want to pay attention to, as that's actually the biggest market, is the bond and currency markets. Okay, so this is a trade that we're looking at in our boot camp program. And this has been one of the best indicators of trouble ahead in stocks. Every time the Chinese allow their currency to devalue, now the Trump administration has said that they are purposely devaluing their currency. But the truth is, the Chinese are spending a fortune trying to protect their currency peg. And the last thing Chinese want is for the value of their currency to lose value. Think about it. You print $210 trillion of yuan, and you're going to claim they're worth $30 trillion. And the math is simple, just 210 divided by 7. So the further this goes up, the less China's money is worth. So they don't want their money to be worth less. That's silly. But the problem is nobody wants to own CNY. That's their onshore currency. CNH is the one we're trading in the boot camp. But nobody wants that currency because it's not freely traded. They have strict capital controls. So there's a huge amount of money that's dying to get out of their currency. And the Chinese are not allowing this to happen. But every time the tariffs go up, you can see their recourse is the same. They allow the conversion rate to devalue so that it offsets the tariffs. And so every time they have allowed their currency to find a more natural price, allowing it to devalue, we've seen stocks sell off rapidly. And so after October, when they had this phase 1 deal, you can see we went from a very high level at 7.15 and broke back down to 7.03. Now, for a long time, their goal was to never let it go above 7 and to keep it at the 6.5 range. But again, they've lost $1 trillion of their reserves. So they went from 4 trillion down to 3 trillion ever since this trade war has really ramped up. So this is costing them a fortune. And if they do let this currency devalue, it causes a domino effect where all the other emerging markets begin to devalue. And if you pull up a chart of all of the top 20 currencies in the world, not a single one has held their value against the dollar, except for a very small handful of pegs, which includes the Hong Kong peg. Now, this index takes a look at the dollar against many different currency pairs. And you can see, despite the Fed increasing the money supply by $320 billion, the fastest speed they've ever done in history, despite lowering interest rates 75 basis points, and despite China not being able to copycat our Federal Reserve's moves because of inflation, you would think the dollar would be crashing by now, but no, it has been on a steady rise and most likely is going to go much higher as China has to allow their currency to devalue, which causes, again, all of their trading partners to either be faced at an unfair trade deal or they copy China and also devalue. So the big picture is China's slowing down. They're trying to mitigate this huge amount of debt they've picked up, which is essentially just loaning themselves money from their own currency. And this is causing all of their trading partners to be in severe pain at this point in time too. And they've all issued trillions of dollars of debt denominated in dollars. So just to pay the interest on their debts is costing them something like $500 billion a year just to service the debt. So they're constantly having to convert their currency into dollars just to pay their debt. This is not something that's going to go away. So my expectation is China is going to slow down and crash, and this is going to cause the dollar to go much higher. So the short-term reaction is we get a little bit of a crash in the SPY and a big push up in the bond market. But then I think we'll see the reversal and stocks fly higher. And this all works until we get to, again, 0% rates. All right, let me pull up our bootcamp content so we can tie this all together and give you guys a big picture of what I think is going to happen. And let's see, let me ask if we have any questions out there real quick. Don Smith, Marvin, I know you guys are new. A lot of the other folks on here have seen these charts a million times, but Marvin and Don, do you have any questions?
Robert, heb jij een affiliate? Huh?
No, I'm trying to.
What was that, Marvin? Do you have a question? Or you're still listening?
No, I'm still listening.
Okay, great. So here's the big picture. This chart really summarizes everything. So this will probably be our last chart for today, as I want to get ready for our module 3 for our boot camp members. We're not in a 10-year, 11-year business cycle, we're really in a 40-year cycle. And actually yesterday, the fellow who made this all possible, Paul Volcker, passed away. And so what he'll be remembered for was fighting inflation in the 70s. And that inflation was created from massive government spending in the 50s and 60s. So we came out of World War II, and after all this pain and suffering, pretty much everyone around the world went on a massive spending spree. Governments created all sorts of social programs, social nets. We went into a Cold War with Russia. And the bottom line is we spent a whole lot more money than we made. And eventually, it took quite some time, but eventually, as the money made it out of these different asset classes and into the real economy, it started to create rising inflation. And so to fight the inflation, the Federal Reserve has a simple strategy. And in the blue line, we see inflation. In the red line, we see the federal funds rate. And so what does the federal fund rate do every time inflation perks up? They rocket the rates higher. And when rates go higher, you end up with negative GDP growth. And you can see every time they hike those rates in this chart, what happens? GDP growth declines. GDP growth declines, stocks crash, and bonds crash if rates go up. So there's a few times in history where bonds and stocks tank, and it's always when the Federal Reserve cuts off the easy money. And so Paul Volcker pushed interest rates all the way to 20% by 1980. And it's because we've been able to have Alan Greenspan, Ben Bernanke, Janet Yellen, Jerome Powell come in and just slowly but gradually drop these rates lower and lower, that we've been able to have these very short recessions. So we have a recession in the early 90s, a recession, let me get that slide off, a recession in the two early dot-com crash, and then we had the housing bubble. But in all instances, they were able to shorten the length of those recessions by simply cutting rates by around 5% and doing a little quantitative easing after the stocks had crashed. So essentially the banks were buying up bonds into these recessions as the Fed lowers rates. The banks get bailed out, sell their bonds to the Treasury, or rather to the Federal Reserve, for a huge profit. And then the banks buy up stocks at a 50% discount. So they've been doing this every 10 years, like clockwork. And so now we're at the point where they're cutting rates because we're headed towards a recession. And this time around, they can't cut rates 5%. You can see the change of rates in the 90s went from 9% down to about 4%, and that saved the day. In the dot-com bubble, we went from 7 to 2, that saved the day. And in the housing bubble, we went from 5 to 0. Now, because the debt has grown every single time that the cost of money has gone down, the markets become extremely sensitive to any kind of rate hike. So you can see they tried to boost rates in 2018, and we ended up with 98% of all asset classes closing out 2018 with a loss. So what did they go to? They went right back to cutting rates and doing QE. So that's where we're at now. The problem is we're coming to the lower bound, which is 0%. And so once you get there, you're going to have to essentially relive what you saw from the 1960s into the 1980s. And so my expectation is we can bounce around from 0 to 2% on the federal funds rate for a while, but eventually inflation will spoil the fun, and we're going to have to jack these interest rates back up. So we've got at least 12 to 24 months, most likely, before we hit 0%. And then that's where most trading strategies will break down. And there's probably going to be a lot of chaos, something more like the 70s, where we have a negative stock market and negative bonds. And so you can see a lot of people think they can just buy and hold through the next crisis and be fine with their stock portfolio. But the problem is we're at 0% rates. So that strategy is just not going to work because they can't save the day by cutting rates again. And so if you look at the period of 1965 through 1980, you had a 15-year bear market. And that was for stocks and bonds. So I think most investors are completely unaware of this and really don't know what's headed their way. So, okay, that's a breakdown of our strategy for today. If you do join us on the next few days, we'll have more time and I can go through a much more detailed presentation for you guys. But I do want to get ready for our Module 3 boot camp. We're going to be talking about currencies in great detail. If you are new to the program and want to join our boot camp, you get a free month when you upgrade your free trial. So call Dean at 505-322-7515. And at this point, I do want to open it up for any last questions. Marvin, do you have any questions so far about how the trading plan works?
I'm still a little confused.
Sure. So I do have about 20 minutes for Q&A before I got to go. Let's just look at the trading plan really quick and see if this makes sense. So does this slide make sense to you right here?
Yeah. Okay.
So what do we trade on Monday, Wednesday, Friday?
On Monday, Wednesday, and Friday, you've traded what? SPY.
Okay. And what time do we do our trades?
You typically take them at I would imagine when the market opens, 9:30.
Yeah, we do it at noon Eastern. So it gives a little bit of time for the market to open, digest the news, and for everybody to be ready to take the trade at the same time.
I see.
Okay, so you get that. Now, what do we trade on Tuesday?
I believe it was TLT.
We'll look at the slide right up on the screen right now.
Okay, so it's EEM Tuesday. Oh, it's right there in front of my face.
Now, are you
EEM.
familiar with what EEM is?
No, I'm not.
Okay, so that's emerging markets. That's an ETF that actually owns a basket of 1,000 stocks, primarily in Asia, India, Russia, South Korea.
And that's all commodities, or?
No, that's like Tencent, Alibaba, Samsung. It's all the biggest tech and financial companies in Asia are held in emerging markets ETF. So outside of the SPY and QQQ, the most highly rated ETF in the world is emerging markets.
Okay.
Now, do you know what the SPY ETF is?
No, I don't. See, this is all new to me.
Okay, sure. So SPY ETF is the top 500 American companies. So it's primarily Apple, Microsoft, Google, Amazon. But if you were to try to buy all 500 companies, obviously you'd need a huge portfolio. So that's why this is the single most popular ETF in the world. Because for $3.14 a share, you have a very diverse portfolio of 500 different stocks in it. And so this removes business risk. If you buy a single stock, now you're risking all your money on a single company. If they have one bad earnings or one bad lawsuit, all of a sudden that stock could really sell off and cause a large loss. But with the SPY, you actually need the whole stock market to sell off before you have any pain.
Gotcha. So
Now, what do you see as the total cost to build our portfolio in terms of these 4 ETFs? How much money would it cost?
Total, looking right around 60,000 or 75K rather.
Yep, 75,000 to build the portfolio.
Yeah.
Now, what's the TLT ETF? Are you familiar with that?
Nope, not
Okay,
at
so,
all.
okay, so TLT are treasuries.
Uh-huh.
And more specifically, the bond market's really cut into three, they've nicknamed it three types. So if you have a US Treasury that has less than a year, it's called a T-bill. If it's between a year and 10 years, it's a note. And if it's a 20 or 30-year Treasury, then it's a bond.
Okay.
And so we're owning the long end, the bond market with the TLT. Now, what about GDX? Do you know what that ETF is?
GDX. Is that gold and so forth?
Yeah, that's your gold miner ETF. So it's not spot gold, it's the people who mine gold.
Okay.
Now, what's important about these four assets?
Very liquid.
That's good. They're liquid. What else is important about them? How about the relationship between them?
I believe that if I was listening earlier, when one is going up, the other one is actually going in the other direction. So it's like a good indicator on which direction you want to trade each asset.
Close. Yeah. So they're uncorrelated. Very good. So they're uncorrelated. That means we're not putting all our eggs in one basket. Now, in general, we can get the direction right on all four assets and generate a profit on all four. But we should not expect to generate the profit at the exact same time.
Okay.
Now, if the SPY goes up, what direction would you expect the TLT to travel?
TLT would travel south if SPY is going up.
Yep.
No, sorry. It's going up with SPY because it's a general market.
No, you're right. So if the SPY goes up, TLT goes down.
Okay.
TLT goes up, SPY goes down. But in general, they're both going up over time.
Uh-huh.
So it allows us to make a very smooth return.
So will those be like when one is going the opposite direction, would it be caused by a spike or news?
Yeah, so the biggest market in the world is by far the bond market, especially government bonds. And so that's mostly central banks and your mega banks that buy these products.
Okay.
But yeah, in general, if money's flowing into the stock market, you're going to see the bond market have less trading volume. So it goes down a little bit. But the second the stock market gets scared, sells off, where does that money go? It goes right to the bond market.
To the bond market.
So because of that relationship, it's very hard to lose very much capital at a single time. What's the largest loss our strategy has had in the last 12 months in a year or in a month period?
Largest loss? 1%.
You got it. Now, what's our target return with this strategy?
1.25% or 1%.
Yes, we're only trying to make 1% a month, and our largest loss is negative 1%.
1%. So that's pretty much
11 of 12. Now, let me ask you this: do you have enough capital to follow the trading plan?
No, I don't. That's 75,000. No, I don't.
Okay, now do you have, so another option is to trade just the Tuesday and Thursday trade, where you would just trade emerging markets and the TLT. And that costs about 30,000 to build, 35,000. Do you have 35,000 you can put into the strategy?
I don't have that kind of cash laying around. No, I don't. Sorry.
Okay. That's okay. Well, it's good to realize that this would probably be a hard strategy for you to follow until you do have a little more capital.
Right. Yep. I can respect that. So, yeah, I don't have that kind of cash.
No, yeah, no worries. Well, your questions are great. I think it helps serve other people who are listening in. Now, Donald, Ronald, and William, any last questions before we get ready for the boot camp?
No, I'm good. I'm good.
Yeah, Ronald knows the whole spiel pretty well now,
Yeah, pretty much.
huh? William, Don, any questions? All right, guys. Well, I'll catch you on the boot camp module in about 40 minutes, and we'll be closing our SPY trade tomorrow. So thank you so much for joining us live. We'll
Thanks,
see you in a
Jason.
few.
Appreciate it.